Mayuresh as well joins in from Angel Broking. Mayuresh, how do you feel about tyre stocks? CLS and India Infoline have both given buy calls on Apollo tyres with price targets of 335 and 340. I know crude is the biggest unknown and the biggest moving part when you talk about tyre companies like Apollo, but it's done nothing for the last 6 to 8 weeks now. Positionally, is Apollo tyres a good stock to buy and hold?
Good morning, Samina. I think for the industry as a whole, you're right. I think with crude and crude derivative prices actually moving northwards, you are probably going to see the pain because 18 to 20% does probably get affected in terms of the raw material contribution from crude derivatives. On the other hand, when you're probably talking about the auto demand probably holding up very, very strongly for the Indian markets and the expectations of both the OEM side of the business and the replacement side of the business actually holding up in terms of volumes for these tire makers. Yes, I think the aspects in terms of the business, whether it's a CV-led business, a PV-led business, tractors, I think the volume growth is looking very, very evident. The cost push-through has probably enforced these tire makers to enforce these price hikes that they've taken over the past few months. And to that bit, I think the protection of margins is a given. Having said that, I think for Apollo Tyres in particular, I think the plant in Hungary that is expected to come up and the expected demand to run through this plant will give it the leverage for its European operations. For the domestic scene, I think it's looking good for tire makers. And again, I think the anti-imposition, the duty that has got imposed for tires from China, that also should abet tire makers within the heavy commercial space. So I think it's a hold on Apollo Tyres from our side. But again, I think we'll be very, very specific within this space.
Mayuresh, quick question. I'm not sure if you track CG Power. But if you track, then any sort of opinion on that stock? Because over the last almost 5 sessions, there has been some significant changes happening for the stock. We actually first got the sort of rating upgrade, then brokerage upgrades. So if you track, what's changing for the company and what would be your outlook?
Not really sure, Piyush, on why the outlook has changed suddenly. I think there is still going to be some amount of pressure points as far as the margins and the bottom line is concerned. Yes, I think the order book looks pretty decent, but what happens in terms of the entire restructuring, both for the European operations and how effectively they're able to probably transmit all these changes into bottom line growth is going to be extremely critical. So I think the cash flows are still going to be sticky in my opinion. So I think we still maintain a neutral view on this.
I mean, the trade there is very obvious. It's so crude related. Mayuresh, I know it's tough to look beyond crude when you look at these OMCs, but would these stocks look like buy calls? I know when you take a call on OMC, you're almost taking a call on crude prices, but would these be stocks you'd pick up in Indian Oil and HPCL, BPCL, or it's best not to avoid this space?
No, so I mean, again, I think you're right. I think the sensitivity to crude, to their earnings profile is quite significant. Add to that, the rupee depreciations, again, the dollar is not abetting their earnings call. So to that bit, again, I think the broad assumptions that one probably goes with crude staying in that range of 70-80, the rupee against the dollar probably staying in a range between 67 and 68.5, and the assumptions that the minister has given probably no tweaking in terms of marketing margins. So what largely probably happens is with the fall in prices, they have largely just stated the kind of earnings impact that one can probably feel. And even if crude prices move up and the government is forced to take some decisions in terms of capping of margins in the worst case scenario, my own sense is that IOC probably, in my opinion, still looks better placed. Again, I think OMCs as a pack, I think the kind of capex that they have announced specifically in terms of the new refining plants and the product cracks that we're probably seeing specifically in terms of the middle range, I think the distillate yield should probably hold up for the OMC stocks. Add that up with the Paradeep facility, I think, operating at full capacity and the utilization level probably giving the leverage to IOC on their balance sheet. So again, I think I have reduced the multiples in terms of EV/EBITDA, in terms of their petchem business and even on the terms of their pipeline business. But largely, I think the refining business should hold up. The volume specifically should probably offset the kind of forward multiple devaluation that we're probably talking about element in terms of their petchem business, but large element in terms of even the investments that they've done, the dividend yield that they give. I think any decline probably within the OMC pack, IOC in my opinion remains best placed.
Mayuresh, I don't know whether we've got a fundamental call from you on Bata, but how good is that stock looking? So leather stocks, leather counters, so it's not just Bata, Liberty, Relaxo, all these counters have been doing well as a pack. It could be a morning of consolidation for all of them. Does this feature on your list of stocks that you own in your portfolio?
Yes, I think the outlook, Samina, looks quite promising for footwear and leather counters. So in that sense, again, what you're probably talking about in terms of part of the gross margins that they've posted for FY18 have been phenomenal at 54.5%. When you're talking about the improvement in EBITDA margins because of cost optimization, the product mix that they've got. And again, I think the kind of capping off the rental expenses at 13.6% has enabled them to post EBITDA margins of 13.8 odd percent. Add to that, I think the cash-rich balance sheet that they possess. As on 31st March, they had 588 crores of cash on their balance sheet. And again, I think the strategy of opening up 100 odd stores in tier 2, tier 3 cities, the recent ads that you've seen, ladies footwear, again, I think that's a huge value addition in terms of the product mix as well as the driver for earnings going forward, as well as the children's footwear. So I think they've got a variety. They've got a lot of products within their mix. I think that online site or their e-commerce site is probably doing the right things for them as well. So I think they're expecting a steady growth for about 18% top line, 20% bottom line, maybe an EPS of around 28-29 odd rupees for FY20. So a tad bit expensive from a near-term perspective, but as things point out, if all these things start moving, the earnings should improve. Similarly for Relaxo, I think if you look at a 5 to 6% market share that they've got, below 500 rupees GST rates are far more lower. So I think the organized players are reaping the benefit in the footwear industry from the unorganized players. You're probably talking about ROCs in excess of 25 odd percent for Relaxo, 20% ROEs, debt equity is almost around 0.15, which is very, very negligible in my opinion. And over the past 5 years, they've given a 14% top line, 22% EBITDA, 28% bottom line growth. So that's a phenomenal performance. So yes, I think as a view, as a house, I think we remain very, very optimistic on footwear.
Mayuresh, you want to tell us what you're recommending to your viewers, to our viewers or to your clients? Any stocks that still are looking compelling enough to, add to your list?
So from a bottom-up perspective, Samina, I think what you're probably liking at this point of time can be an Aditya Birla Capital. The entire theme in terms of financialization of savings is going to play out pretty well over the next few years. And a lot of stocks within this sector itself might do well. For Aditya Birla Capital, I think it's well diversified. So their NBFC book is growing at a pace of around 25-30 odd percent. Their asset size has actually reached around 34,700 odd crores in terms of AUM. What you're talking about in terms of stability, 30 odd percent. Their asset size has actually reached around 34,700 odd crores in terms of AUM. What you're talking about in terms of stability for asset quality, it's 0.9 on the GNPAs, 0.5 on net NPAs. NIMs have been maintained at 4.5% as well. On the asset management business has been growing pretty steadily as well. The equity SIP inflow that you're probably witnessing over the past 1 year and continuing, I think, is going to create a huge amount of impetus for their asset management business, specifically in terms of equity AUMs. The housing finance business has almost doubled in terms of the loan growth. So I think 8,200 crores is what they probably achieved in the year gone by, with NIMs of almost 3.3%. They've also got a life insurance business which has got positive value of new business margins for the year gone by. So I think it's a complete play in terms of all different sub-segments of the financial aspect of the economy. And in that sense, I think from a valuation perspective, it's not looking very expensive. So I think Aditya Birla Capital is something that we'll prefer at this point of time.
Thanks, gentlemen, for joining in. The market is looking